My name is Jake, welcome to the channel. In today's video, we're gonna do a Review My Pie video where I review subscriber portfolios. This is one of my favorite series on the channel. It's a great way for me to interact with you. I love reading your emails. I love seeing how different people all across the globe are viewing the topic of dividend investing because there really isn't a one size fits all. But these Review My Pie videos, they're a little bit different than the other videos that I make on my channel. I would say they're a little bit more laid back. It's more personable. At least I try to make it that way. I don't edit the videos as much. It's more so as if you and I were sitting in a room, we were sitting next to each other and you're just having a conversation. And that's how I try to make these videos, make it as personable as I can, because at the end of the day, I'm just a normal dude, guys. Like I wasn't fed with a silver spoon. I'm pretty normal, kind of ish. I am weird. Asterisk there, I am a bit weird, but I have an interesting sense of humor. But hopefully you can relate to, the things that I'm saying, and hopefully we can build that connection here. Even though, you can't see me, I hope that, what I'm saying resonates with you and that it's relatable and that you get value out of my videos. So in today's Review My Pie, we're going to answer a question that I got on one of my videos here a couple of days ago, and then we're going to take a look at three portfolios. The first is going to be from a 42-year-old here in the United States, the second a 20-year-old from Turkey, and then the third a 32-year-old from the US. And if you're not quite sure about Turkey, Turkey is over here. It's partly in Europe and partly in Asia. So I've actually been to Istanbul. I've been to the European side. I've been to the Asian side. I visited here about 10 years ago. I love the Turkish delight. I love the apricots, all that good stuff. But my favorite part about visiting Turkey was actually going to a city called Cappadocia, and we took a flight from Istanbul over to Cappadocia, just in the area there, and it was such an incredible experience where, let's see if I can pull this up. I want to show you this really quick. I actually got to go and do this. I think this was like a year out of college or something. I can't remember exactly what year, but I got to go at 5 a.m. into these hot air balloons. It was such a cool experience. Let me see if I can show you some of this. Yeah, so I went and I did this. Let's see. Yeah. Oh man, I still remember it as if it was yesterday. It was absolutely beautiful. If you ever go to Turkey, go to Istanbul, if you have the opportunity, fly out to Cappadocia. They have some amazing sites that you can go and check out, the caves, and definitely if you go out there, go on the hot air balloons. It was the most incredible experience that I just to this day, I think it was over 10 years ago, but I still remember as if it was yesterday. Such an amazing experience. And as always, everybody, I will leave timestamps in the description below. So if you're just interested in one portfolio or another, and if your time horizon or your age group is not, showing here on this video, you can check out my other videos on the channel where I've talked about all different time horizons, and as well as the portfolio links, if they're there, will be in the description below. And as always, everybody, I'm not a financial advisor. Please don't take what I'm saying as financial advice. It's just merely for your entertainment. And I do not script what I'm saying. I don't review the portfolios in advance. I'm reviewing them as I'm recording this to try to make it as authentic as I possibly can. And my goal with these videos is really to inspire you to find your own way and not to just copy what other people are doing. But if you were to just copy what other people are doing, it may look a little like this.
Hi, everyone. I'm Egemen. Tesla, very cool. Hi, everyone. I'm Egemen. I love you guys. Never give up. Never give up. Wow.
Oh my gosh. Oh man, I love it. I love it. Whenever I see that guy, it always puts the biggest smile on my face. Oh my gosh. All right, cool. So let's take a look at this question here. I got this on one of my videos a couple of days ago, and I see this question all the time, and it's more of a newbie question, but if you don't have this foundation, it can make it very, very difficult to figure this whole thing out, especially if you're trying to build a portfolio that you can one day live off of. It's important that you have this foundational understanding of the differences here, because really what it ties into here is understanding your investment time horizon and learning how to invest based off of your time horizon. Now, if you don't understand what I just said, you need to watch that other video that I made after this when I talk about how to invest based off of your investing time horizon. You can check it out on my channel. But the question here, it says, maybe I'm missing something, but if I'm still in my 20s, why wouldn't I want to go with the higher dividend yield? Can someone please tell me the benefits of a lower yield companies? So the important thing here is there's a couple of different angles that you can take a look at this. So if you're in your early 20s and you're investing in a taxable account, so you're going to be paying taxes, that's the first thing that you want to understand is you don't want to, when you're investing into higher dividend stocks, it can work for or against you in some cases. And if you don't plan on living off of the dividend in the future, you're being forced to pay taxes on those the dividends or the distributions, depending on if you're investing in REITs or covered call ETFs, bonds, etc. So the very first thing that you want to take into consideration is the tax implication that comes with investing into a dividend investing or dividend growth strategy. Now, obviously, if you're investing into a Roth IRA, 401k, the taxes don't play a role, but even more important than taxes, the taxes are only a small piece of it. It can be a big piece, but it's only a piece of it. The biggest thing is what's called total returns. When you're investing into a high dividend stock or ETF, generally you're sacrificing on the total return. So what is a total return? A total return is what you get in an investment that is the capital appreciation plus the dividend. That represents the total return. And generally with ETFs or dividend stocks that have a higher dividend yield, you're going to get a higher weighting in the dividend and lower weighting in the capital appreciation. And if you're in your 20s and you have a long-term time horizon, you want to flip that around. You want to have higher growth, capital appreciation plus the dividend appreciation, because over the long term, that's going to benefit you more and going to compound more and is going to give you a higher total return than just getting a high dividend and reinvesting the dividend. Does that make sense? So it's not always the case, but I would go so far as to say 9 times out of 10, you are better off focusing on the total return and understanding, if you're new to this. And so what you're missing here is understanding total returns and where that return is coming from. The dividend is just a piece of the total return. And when you're in your 20s, and let's say you have a 20 or a 30-year time horizon, you want to focus more on growth, because also what I mentioned earlier with the taxes, if you're focused more on growth, the yield, it's going to grow faster and it's going to compound faster, and you're not going to be burdened by that tax burden up front, but rather towards the later ends before you reach retirement, it's going to snowball, right? You may have heard of, the dividend snowball. That's really the power here versus, paying high taxes if it's in a taxable account. But even if it's in a tax sheltered account like a Roth IRA, your total returns are most likely going to be lower in a high dividend stock compared to a dividend growth or a growth stock. If you were to flip that upside down and say, well, I have the money today and I'm retiring tomorrow, well then, yeah, what you would want to focus on, if you're looking for income and yield, then you would look for an investment that has a higher weighting in the dividend. And we think about the total return, you got the dividend and the capital appreciation. If you've already accumulated your wealth and you're looking for income, then you can flip it upside down from what I just said and focus on higher yielding assets. When you're thinking about this, if you're in your 20s and you have a long-term time horizon, meaning you're not going to live off the dividend in the next 10, 20, 30 years, you really want to focus on a dividend that is growing and focus on total returns. So I hope that that helps. If you have further questions, leave a comment below. I can respond to it, or I'm sure there's dozens of people here watching the video that can comment further on, if you have any other questions when it comes to this. But great question. Thank you for asking it. And once again, if you want further information on this, understand and watch those videos that I made on how to invest based off of your investing time horizon. So let's take a look at the first portfolio here from Eddie. He writes, "Hey, love your channel and have learned much from your insight. I'm 42 and about to retire in another 1.5 years. So I'm looking for a high yield dividend portfolio with great growth. Would love for you to review what I have set up in M1 Finance. Appreciate all that you do, Eddie." Now, this actually ties in really, really well with the question that we just took a look at, because Eddie's time horizon here is fundamentally different than the person who wrote the question, who maybe he's in their 20s. So Eddie here has already accumulated his wealth, and now he's looking to maybe rebalance or to, structure his portfolio so that he can go from the growth phase to more of the the income-oriented phase of his life, right? And so this is very, very different, and this is why understanding investment time horizons is so important. So before we dive into the portfolio, just a few general thoughts. I love that you're putting an emphasis on the yield and the growth. You're 42 years old. You could live another 40 or 50 years. So you want to make sure that your portfolio is outpacing inflation and that it's still continuing to grow. Okay. So that's core to everything. If you're going to retire early off of your dividend portfolio, like Eddie's trying to do here, it's incredibly important that your portfolio is still growing and that you're not 100% just into, cover call ETFs or, companies that are maybe about to cut their dividends. So it's incredibly important to have kind of a holistic approach to how you're viewing this and not just look at one metric, for example, the dividend yield. All right, let's take a look at his portfolio here. We can't see all of the historical performance, but what we want to take a look at is we want to look at the number of holdings, the dividend yield itself, and the expense ratio. So the dividend yield is actually really good. If you're looking to retire in the next 1-2 years, a 4.5% starting dividend yield is good. The expense ratio I really like as well. The number of holdings is manageable. It's not a crazy high amount. This is probably about where you probably wouldn't want to go over 30 holdings. It just makes your life so much easier. So let's take a look and see how you have it structured here. You got VYM is your largest position. You got QYLD as well. So QYLD is a cover call ETF. This is okay. Not my favorite cover call ETF. I personally like JEPQ a bit more, simply because of the strategy of how they write their cover calls. With JEPQ, you get a little bit more potential for growth than QYLD. So that's the very first thing. I would do a comparison of QYLD versus JEPQ from JP Morgan. The expense ratio is lower. JEPQ is, in terms of full disclosure, I used to invest into QYLD. I sold out of it and bought JEPQ, and I'm very happy that I did so. It's maybe not the right approach for you, but kind of compare and contrast how those two ETFs are set up. So that's my recommendation there. But 10% in a cover call ETF, I think is fine. Okay. What I wouldn't do is I wouldn't go heavy into some of these yield max cover call ETFs where you have single stock exposure, where it's like 100% into Tesla or Coinbase or some of these others. I like more index focused cover call ETFs if you're going to go with them. So something that I personally like. Let's see what you have in here. You got consumers, financials. Let's take a look at these here. In consumers, you got McDonald's, Genuine Parts. Okay. Lowe's, I think I invested in McDonald's. I like McDonald's. I like Lowe's. Genuine Parts, I just don't know enough about it. With this whole EV revolution going on, I just don't know how. I kind of look at it, maybe this is wrong, but this is just kind of how I categorize it, is like with Leggett & Platt. Like, how is this going to fare in this next wave of innovation with EVs and everything? I'm just kind of on the fence. I don't know how that's going to work. Maybe somebody that's done the research can educate me. I just don't know. I just don't know the space as well. but something to keep an eye on. The next one here, you got BlackRock. Here, this is your financials: BlackRock, Main, RS, and Visa. Okay. I do like the blended dividend yield, right? You got Visa, which is fundamentally different than the rest here. So I do like the blended dividend yield. I like that it's simple. I like that you have it equally weighted. I think that's fine. Real estate, you got Stag, Realty Income, WPC. So you got industrials, you got retail, and you got a little bit. This is a diversified, even though I think they sold out of their, they divested from their offices. So it's kind of interesting. WPC, they reduced their distribution, but I like Stag, I like Realty Income, I like Prologis, I do like American Tower. Yeah, okay. And it's only 8%. It's probably in a taxable account if you're retiring, before the age of 59. I do like that it's not heavy in a non-qualified dividend, which I do like, which is good. AT&T, wait, what is this? Wait, communications? You got 7% into AT&T? Are you crazy? Man, oof. I don't like this. I would never, first off, AT&T, I would probably limit to like 1 or 2%, if that, if I even had it in the portfolio. I'm just not a big fan of them. They're ridden with debt. Technology, innovation is disrupting them left and right. I don't know. It's a difficult sector. 7%, not a fan of it. I would lower that completely. Like, I would get out of this, me personally, and I would add 7% into SEHD and immediately overnight get immediate, diversification. Yeah, your yield is going to go down, but what happens if I don't like it. So, but to each their own. Consumer defensive, Altria, Coca-Cola, Kraft, Procter & Gamble, Target. I do like this. A couple of things that come to mind. Coke is raising its dividend. Procter & Gamble, Target, they raise their dividend. Kraft Heinz, not so much raising their dividend. Altria Group's kind of going through a rut with their dividend growth. They're chugging along. So what you said in your emails, you want a mixture of yield and growth. And I think this is a good approach. Now, if you had like 80% into Kraft Heinz, that would be wrong in my opinion. But the fact that you have it blended, I think is a good approach because you're still going to get dividend growth. You still want to get at least 4 or 5% at the minimum dividend growth year over year to at least outpace inflation, right? So healthcare, what do you got in healthcare? You got Johnson & Johnson, you got AbbVie. How much do you have in healthcare? Okay, 3% in each. Okay, that's fine. I don't have anything against that. Technology, you got IBM and Microsoft. IBM has been on a tear. Like, I think it's like at all-time highs, is it not? Oh my gosh, incredible. Who would have thought? IBM, they're coming back to life. Okay, cool. That's fine. What I'm looking for is like over concentration. The ones with AT&T, that's the one where I'm like, so I'm looking for concentration and stuff like that. You got Exxon and you got Chevron. Okay, good for, a strong yield today. I personally don't invest into individual, oil or energy stocks like that. I get my oil diversification through my high dividend ETFs like VYM. I'm already getting exposure to oil in VYM. And if oil, does well, I do well by default because I get exposure through VYM. If oil fails in the next 30, 50 years, I don't know. I don't have a crystal ball. I don't take the single stock exposure or risk because, year over year, it'll be lowered. The weighting will be lowered in these market cap weighted ETFs like VYM. So that's kind of how I view energy and why I don't invest into it individually. So something to maybe consider. If you're on the fence with owning an individual stock, you can see if it's represented in one of your ETFs and you can kind of look at it. Well, if they do well, I get more exposure. I kind of look at that like with NVIDIA or these growth stocks. And when I invest into, my growth ETFs in my Roth IRA, if they do well, I do well because it will be represented in the index that I own in my Roth IRA. For example, I own VTI and VGT and VXUS. Like I have market cap weighted indices in my Roth IRA. But even with DGRO, right? If Microsoft continues to do well, I will continue to hold it in DGRO. So something to consider. That's how I view it. So if I'm ever on the fence with a stock, I first look at, okay, well, do I already own it in my ETFs? And I figure, well, do I want the extra exposure of the single stock risk? And if I'm ever on the fence, if I'm ever like, I just take it out and I enjoy it in my ETFs. And if they do well, great, I have it in my ETFs. If they don't do well, okay, whatever. I don't take any of the risk. So that's why I really am a huge fan of these market cap weighted indices. My favorites are SAHD and DGRO. I think it's like, mwah. It's chef's kiss if you're looking to live off of your dividend portfolio. But anyway, so you got Honeywell, Caterpillar. I'm kind of going off on a rant here a little bit. I like this approach. I think it's reasonable. It's manageable. I like those utilities. You got in here basic materials. You got all really good stocks. I mean, there's really nothing wrong with this. I think if I were to spruce this up, if you were sitting next to me and say, hey man, in early retirement, do you really want to follow up on all these companies? There's probably a way that you can make it a little bit more passive. And I like that you're kind of doing a core and satellite, but in my opinion, I would, bump these ETFs up a little bit more. I'd throw in an SCHD and a DGRO to kind of cover your basis. And then, see if you can get more exposure into these ETFs. I think, 60 to 80% into ETFs and then the rest split across individual stocks equally or, somewhere in there, I think is the way to go. But I don't think there's anything wrong with this. I don't think this is going to be the right approach for most people. And I would go so far as to bet you that probably down the road, you're probably going to adjust this because it's just going to be too much. And unless you love looking at your stocks every day, then this is the right approach. But for everybody else that wants to make it a little bit more passive, I would skew a little bit heavier into ETFs. Reconsider a few of these, like with the AT&Ts, maybe lower the allocation. But overall, I think your strategy is good. Try to keep a good mixture, a good balance of dividend growth and yield. And I think you're going to have a great early retirement living off of your dividend portfolio. Thank you so much for sending over your portfolio. All right, let's take a look at the next one here from Egemen. He writes, hello, Jake, I'm Egemen. I hope I'm pronouncing that right. And I love watching you from Turkey. I will be 20 years old in 12 days, and I'm studying English language teaching at a university in Turkey. My goal in investing is to gain financial freedom and travel to many countries. The money I can invest for a month is approximately $125. I think a very good amount considering the country I live in. Absolutely. I think the portfolio I have made is an unusual portfolio, but I have my own reasons and I will explain it because I am curious about your opinions. Here's my portfolio. You got DGRO, SHD. Well, you can't go wrong with that in my opinion. You got MPWR, not MPW. I think it's a new Broadcom of the future. Dividend increases will be good. Okay. Dell, I think this will produce okay, so you got Dell computers, you got Tesla, MPLX. Okay. You got McDonald's. I eat at least once a month. Starbucks, I drink a few times a year. Okay, cool. I have high expectations from this duo. Okay, McDonald's and Starbucks. And you got TMC. They are mining under the ocean if the state's okay. RKLB, they carry out small-scale cargo transportation to space. Okay, that's pretty cool. I think it'll be like a SpaceX in the future. Thank you for your comments about my portfolio. Have a nice day, Jake. Okay, so Egemen, thank you so much for the email. I think this is so cool, man. I think, this approach right here is ideal for the core and satellite, right? You got your core made up of low fee, broad-based index funds. And if you're trying to live off of the income from your portfolio, I love SHD. I love DGRO. I would make that 60, 70, 80% more the better in my opinion. And then these others, that's your core. SHD and DGRO, that's your core. And then these others, these are your satellite. Man, if you wanted to throw in Bitcoin and maybe you like, baseball cards or you love doing whatever else, everything else can be a satellite position and it doesn't really matter. It's up to you. The satellite positions, you hold them for two reasons, in my opinion. One, you hold them for the emotional side of it because investing is emotional, right? You even say it yourself. You have high expectations from this duo. You eat there once a month at McDonald's, a few times a year at Starbucks. So you're a fan of the brand. So it's more of an emotional tie that you have to these brands. That's completely fine. That's the first reason why you invest in your satellite positions. The second reason is to balance out your portfolio for more growth or for more yield, depending on your time horizon. Okay? How many of you just had the light bulb? Right? That's what it's all about, guys. The core and satellite is perfect if you're trying to construct your portfolio. And if you're nearing retirement, like we just heard from Eddie, his satellite positions are going to be more skewed towards, higher dividend stocks. Now, if you're somebody that's in their 20s who has a 20 or 30-year time horizon, well, your satellite positions are going to be more skewed towards growth or dividend growth. Does it make sense? It's pretty straightforward. So if you construct your portfolio like this, this is the framework, right? Guys, the core and satellite, it's your framework. And then the simple path to wealth with dividend investing, having SHD and DGR at your core, it just makes everything so much simpler. So what you're trying to do, I love it. The only thing that I would say is make sure that you get your weighting allocation under control, because if you're like 80% into Tesla, well, shouldn't be watching my channel. You should go watch somebody that's, talking about growth investing, about Tesla. But if you're a dividend investor and you want to live off your income from your portfolio, I think if you construct it like the core and satellite, I think you're going to do incredibly well. And so this is how I would construct it. I've been investing for about 15 years. I wish somebody would have told me about the core and satellite years and years ago. It would have saved me a lot of headaches, a lot of stress. And so I hope that this is helpful for you. And you know what? It's so cool, man. You have your core and then you have your satellites. You can enjoy it. You can see them grow. Just make sure that you're keeping an eye on the weighting, the percentages, and that you're doing it in a conservative and a responsible way. And if you do that, man, dollar cost average, enjoy your life, enjoy traveling to different countries, and enjoy the journey, man. So thank you so much for sending over your portfolio. Pretty straightforward, simple, and shout out to Turkey. Appreciate it. All right, the last portfolio is from Brendan. He writes, "Hi Jake, I messaged you on Instagram approximately a month ago about reviewing my passive, mostly buy and hold ETF portfolio." Yeah, Brendan, I appreciate you reaching out. Dude, I think you've been in contact with me, I think years ago even. So it's great to see a longtime subscriber. Like I was looking at our messages, it was from years ago. So that's cool. I say mostly because I do have positions allocated to growth. I'm approximately 20 years away from retirement. I'll be retired at around 52 years old with a state pension plus this portfolio. I'm fortunate enough to also own a business and my wife has a good job as well. Most curious on your feedback to this portfolio because I know there's a lot of overlap in holdings. Curious what your thoughts are moving forward. So couple of things, you know your time horizon, 20 years, you're going to have a state pension, you're going to have your portfolio, your wife is working as well. I mean, wouldn't it be so cool if your wife could retire maybe in her mid-40s? If you have kids, maybe your wife could take care of your kids. Maybe you don't have to have your kids go to public school. Maybe your wife could, homeschool your kids and you could have that, that family. Like there's so many cool things that you can do when you're financially, in the position to do different things. You can live a different life and you have different options. And, I say the homeschooling thing because my wife and I, we want to take a different approach to, educating and teaching our son, Lucas. We're planning on homeschooling our son. And a big part of that is we don't want him to go through the system. And, when I was growing up, kids that were homeschooled were always the weird kids. And I think to myself, wait, if the public school system is the benchmark, I don't want my son to be the benchmark. I think we can do much better than the benchmark. And so I have a completely different outlook on homeschooling and how we're going to raise our son compared to what the historical norms were. And so hopefully you're looking at, if you're watching this video, you're thinking that maybe the benchmarks that we were told were always the best way to do things. Maybe that's not the case. And so I'm trying to look at things from a different lens and open my mind to, thinking for myself versus being told what to think. So it's really interesting when you're financially independent and you kind of have that FU money, you think differently about the world and you don't quickly just jump on the bandwagon because you have to. So I don't want to get too far off onto a rant, but that's one of the beautiful things about being financially independent is you have options. All right, so let's take a look at your portfolio. So it's currently valued at $65,000. You have a current yield of 4%. So this is the first thing that we probably want to take a look at to see if we can optimize this. And this kind of ties into the first question that we saw here, that maybe having the highest yield isn't always the best, especially if you have 20 years. Maybe we can optimize that. You have income about $220 a month that you're reinvesting. You have a low expense ratio. This is pretty low. You got 15% into growth ETF VUG. I like VUG. You got VOO. This is the S&P 500. You got SHD. You got DGRO. You got JEPI, VYM, DEVO, IDV, VEA, and VWO. So you got some international here as well. You're pretty broadly diversified across different segments. You got different parts of the market. You got international. You got broad-based. Total U.S. Total. S&P 500. Pretty much total U.S. stock market for the most part. And you have a dividend focus as well. All right, let's see what else you got here. So I add about $200 a week and lump sum whenever I feel like it. This was started approximately 2.5 years ago with $35,000 lump sum investment from an income portfolio that I had, like CLM, QLD. Okay. Luckily, I liquidated those holdings into this. Good idea. Last year was tough, but all my holdings are green now. VUG is borderline, but considering I was down 40% last year, that is fine. As mentioned, I'm aware of the overlap, but all these holdings are solid and wouldn't know where to consolidate. Let me know if there's more info required. Okay, I'd love to hear your thoughts. Well, Brendan, I think this is awesome, man. So first off, there's many different ways that you can approach, something like this. And I want to highlight that there's not a one size fits all. It really comes down to your risk tolerance, your goals, and what you're trying to accomplish here. Okay, so these are very, very different. So VUG and VOO, they're very different than SHD and DGRO. Okay, the way that I think about it is, well, what's your goal with each one of these individual holdings? So what I would recommend you do, and I would recommend this exercise for every one of you watching. If you're doing this, if you're thinking about your portfolio, think about it this way. How does this portfolio fit into your overall investment strategy? Do you have a Roth IRA? Do you have a 403B? Do you have a 401k? How does this portfolio fit into your other accounts? You say you have a state pension, okay? Is this account purely, and I think you actually mentioned that this is growth and dividend. So it's important that you understand what is your goal with your portfolio itself, each investment account, as well as the investments in each account. Because each of these investments, these are vehicles. These vehicles help you get to your destination. And if you don't know what your destination is, destination would be, for example, retire at the age of 52, right? How is that going to help you get there? So VUG is very clearly, for me, this is one that you're going to invest in for growth. And then once you reach the age of 52, for example, you're going to sell out of VUG and rebalance into maybe something that has a higher dividend yield. Maybe, for example, SHD or a JEPI or a JEPQ, a VYM, for example. So this is very clearly a buy, hold, sell, rebalance later. And that is the same for VOO. You're not going to live off of the dividend from VOO. If you are, then you must be a multimillionaire, because for the rest of us, it's very, very difficult to live off the dividend, as well as these international ETFs. Okay, so the only dividend ones that you really have in here, you got 10, 20, 30, 40, 50. So about half of your portfolio, a little more, is focused on dividend investing. The other half is growth. So understanding that you're going to have a different strategy for these are going to buy, hold, rebalance later. I think that's completely fine. These are kind of like your rental properties, where you're going to buy them, hold them, and you're never going to sell them. You're not going to sell them when you're at the age of 52 and when you live off of your portfolio. So as you get closer to retirement, you're kind of going to look to rebalance this portfolio maybe on a yearly or every couple years. This is not a portfolio. This is the good news. This is not a portfolio that you're going to play with and rebalance regularly. Every year or every other year, you would look to maybe update this. That is the most important thing, especially when you're just investing into ETFs. The thing that I would recommend is kind of see how you can look at this as maybe a core and satellite, right? Which of these are your core? Which of these are your satellite? Maybe that might help you to kind of categorize how you view them. But one thing that I would say, this is a little bit nitpicky, but this is very, very important. You said that you have 20 years, right? 20 years. This is what I would recommend you do, okay, is take a look at JEPI and take a look at Devo. You do not need those. You have a high dividend yield of 4%, in my opinion. In my opinion, whether you or anyone else, if this was my portfolio and I had the goal in 20 years to live off my portfolio, I personally would sell JEPI, I would sell Devo, and I would reallocate them into either SHD, DGRO, or one of these. The reason why is it comes back to what I said at the beginning of this video, understanding total returns and the implication of taxes, okay? You don't need this 4% dividend yield. And you're going to get a lower total return with these because these are covered call ETFs. The reason why you're going to get a lower total return is the upside is capped. Because these are covered call ETFs, you're not going to get the full potential in a bull market. In over 20 years, you want the growth potential, okay? Now, here's the cool thing. What you can do is in 20 years, in 18 years, in 15 years, you can slowly start reallocating or rebalancing out of these or adding new money, a couple years before you retire, into JEPI and into Devo. So for the next at least 15 years, you do not want covered call ETFs. And it comes back to the total return, okay? That is so, so important. And if you do that, you lower JEPI, you lower Devo, you're going to have a lower expense ratio, you're going to have a lower yield, you're going to have lower income. But that's okay. You don't need the income. You told me, you said right here, you need the income in 20 years. Why do you need the income today? You don't need it today. You don't need to pay taxes on it today. Even if it's in a Roth IRA, don't misunderstand me. Even if it's in a Roth IRA, tax advantage account, the total return still outweighs it, okay? Really, really important. Getting out of these covered call ETFs, you're gonna have a lower yield, you're gonna pay less taxes, you're gonna have lower income, which is okay, you can have lower expenses, but you're gonna have more growth. You're gonna have a higher total return, or at least the potential for it. I don't know what the market's gonna do. Okay, that's how I would look at this, okay? So those are my thoughts on it. Focus on quality, you're almost there. If you can just tweak this a little bit, I think it would help you a lot. Brendan, the last thing that I'll say is once you've kind of taken my feedback and kind of optimized it based off of how you want to do it, the last thing that you need to do is understand, okay, you're not going to be rebalancing this, you're not going to be reviewing this on a regular basis. The last thing that you want to focus on is this right here, because this is going to move the needle. Once you have the foundation and the blueprint and everything structured, then it comes down to how do you get more money into the portfolio on a weekly basis? How do you cut your expenses? How do you stay out of consumer debt? And how do you make maybe a little bit more money, or how do you get a little bit more money into your portfolio? Because at the end of the day, that's all it comes down to. And it gives you a lot more peace of mind because you're set up for success. Then it just comes down to this piece of the puzzle. How do you get a little bit more money into the portfolio? And that's what you can focus your energy and your time on, because at the end of the day, that is going to move the needle. Adding an extra $100 a week is going to move the needle, okay? So, Brendan, I hope that helps everybody who's watching this video. If you're in a similar situation as Brendan, that's how you move the needle. You get the foundation, you get it all set up, but then you focus on what's gonna have the biggest impact, and that is cutting your expenses, staying out of consumer debt, and how can you make a little bit more money? How can you invest a little bit more money into your portfolio? Thanks for watching, everybody. Hope the video was helpful, and I'll see everyone in next week's video.
Please subscribe. Please subscribe.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.